For decades, if you wanted to buy insurance, your first stop was usually an agent or broker. They explained coverage, shopped for the best rates, and walked you through the process. But with the rise of technology and consumer demand for simplicity, the insurance industry has seen a major shift. Enter direct-to-consumer, or DTC, insurance models. Let's start with what DTC means. Instead of working through an intermediary like an agent or broker, a DTC model allows customers to purchase policies directly from an insurance company, usually online. Think of it like buying a plane ticket or booking a hotel. It's quick, digital, and often requires no human interaction. So why did DTC become such a big deal in the P&C insurance world? Much of it comes down to technology. Insurers develop better websites, mobile apps, and instant quote engines. They leverage data and automation to streamline underwriting and pricing. This made it possible for consumers to buy standard personal lines insurance, like auto, homeowners, and renters insurance, on their own, without needing to speak to someone. And the results speak for themselves. Over the past decade, DTC-focused insurers have gained market share, especially in auto and home insurance. Startups like Lemonade and larger players like Geico and Progressive built massive businesses on the promise of speed, simplicity, and price transparency. But here's the twist. Despite the rise of direct-to-consumer, agents and brokers still handle roughly half of all insurance written in the United States. And in many commercial and specialty lines, they're still the dominant force. Why is that? Because direct-to-consumer works best for simpler, low-touch products. Think personal auto or renter's insurance. These coverages are relatively standardized and require less customization. But when it comes to more complex risks, like commercial property, general liability, or workers' compensation for a mid-sized business, things get complicated. There are more variables, more questions, and more room for risk misinterpretation. Agents and brokers provide crucial value in those situations. They understand the client's business, help tailor coverage, and advocate during claims. They also help businesses navigate nuances in policies that can't be easily digitized. So, where does this leave direct-to-consumer insurance in the future? We'll likely see continued growth in direct-to-consumer for personal lines and micro-commercial insurance, like for sole proprietors or freelancers. Insurers will invest in more AI-powered tools, embedded insurance offers, and personalization to make buying insurance even easier. You might buy insurance at the same time you're signing a lease, booking a trip, or purchasing a vehicle, all digitally. But we're also going to see more hybrid models emerge. Think digital-first platforms that offer direct-to-consumer convenience, backed by human support when needed. Insurtechs and traditional carriers alike are exploring ways to blend the strengths of digital and advisory models, especially as customer expectations continue to evolve. The bottom line? Direct-to-consumer models are reshaping how insurance is distributed, especially for standard coverages. But agents and brokers aren't going anywhere, especially when it comes to complex or high-value risks. Instead, the future of property and casualty insurance is likely a blend of self-service, automation, and expert advice. If you enjoyed this breakdown, don't forget to like, subscribe, and follow Insur Knowledge for more insurance education, career insights, and industry trends made easy to understand.